Hello, good morning, warm welcome. It is time to decode the ET Wealth newspaper, and I am Priyanka Bhatia from Women on Wealth. The downturn is happening. The stock market is going down, right? What you should be doing in this downturn. That's the conversation we're going to have today, and this is the cover story in the ET Wealth newspaper. Let me show you. Well, this is how it looks. The downturn and what you should be doing about it now. So yeah, this is the conversation and let's begin. The first thing it is talking about is you should check the investment horizon. The investment horizon. Now, how will you check the investment horizon? How would you know how much time you want to stay invested? That's directly proportional, that's directly consistent to the financial goals you have. What are those financial goals that you want to reach, and by what time do you want to reach them? Okay, that's the conversation. So what are those financial goals? So say you wanna build your retirement fund. Now, when do you want to retire? How much money would you need to retire? That is always step one when it comes to investment planning, financial planning, or when it comes to following the plan and reviewing it, making changes on the way, in the way, etc. So number one is check the investment horizon. And I would say more. Identify your financial goals. Know how much money you would need, by when. Are your investments going to take you there? Because if you have, say, short-term goals and you're investing in equity, in stocks and mutual funds for achieving short-term goals, that may not be the right step to take. Because stocks and mutual funds are volatile investments. They keep going up and down. You can see already in the downturn. Even good portfolios, even good companies, the stocks of them are down. Maybe not as much down as others, but they're still down. So something that goes up comes down. So stock market does come down. And yeah, that's how it is. Okay. So check the investment horizon. Don't give in to the fear. A lot of us, we operate from fear, and it's just said in the market that we are either operating from fear or operating from greed in the stock market. When the market is going up, we are very greedy. We think, okay, let's buy more and more and more. But if we are not buying good quality stocks, then it ain't going to help. So it's critical that we start managing our emotions, and we manage our emotions by collecting knowledge, understanding, building our understanding of companies, their financial performance, because any company which is doing well financially will do well in the stock market. Its mutual fund will also do well. What are mutual funds? Equity mutual funds are an indirect way of investing in stocks. So yeah, that's the method to do it. That's how you do it. So don't be driven by fear right now in the downturn. Don't be driven by greed when this upticks. Be balanced. Know what you're buying, why you're buying it. Always have your reasons clearly stated on why you're buying something. Right? And then rebalance your portfolio. If you are a lot of women who come to me, okay, they say, yes, I wanna create wealth, I wanna make sure my portfolio is diversified, I wanna pick good quality investments, reach my goals. All of that women say to me, and they've been saying that for 11 years. Now, diversification is a conversation a lot of people have. It's not something which is practical for people. And here in the Money Gym program, we give, or if you're money gymmers and you're listening, we've already given you practical tool to map diversification in your portfolio. So if you are too much skewed towards fixed deposits, savings bank account, too much money is lying into properties or loans, you know that if you're looking at, say, building a retirement fund which is 20 years away, 30 years away, then you got to move towards equity. Stocks and equity mutual funds, that means. Because only then can you reach your financial goals. So rebalancing is an important task. And well, where this is talking about, where this article is coming from is, if the market is declining, do you need to come out of the stock market, equity markets? Well, I don't think so, given how I've seen your portfolios. The Women on Wealth community's portfolios I've already seen. You guys keep submitting your sheets to me. And I know that this doesn't apply right now to us. Once we've grown significantly and you've invested enough in equity, maybe there is a need to come out of it in a balanced way. But right now, our community average age is 30, 40, 45 years old. So we don't need to be taking these actions at this point. Choose the right funds, choose the right investments is another thing that the article is talking about. I know how people buy investments. They buy it on hearsay. Somebody says, okay, this is a good stock to buy, this is a good mutual fund to buy, and we buy. That's a very, very big mistake. Do not invest on hearsay. Do not invest on tips. Ask yourself, if tips could make people wealthy, wouldn't everybody be wealthy by now? We're surrounded by tips. Like all around us, there are tips. It doesn't help. It really, really doesn't help. So we got to go beyond, okay? Go beyond all the get-rich-quick ideas. Learn to pick good quality investments. Learn to diversify an investment portfolio and over time build our investments. When you build your attitude that, okay, I can do this over time, slowly, steadily, you will notice wealth will also get created. The more hurry you make, the more impatience you demonstrate, the more greed you demonstrate, you know you're on the wrong track. The more patient you are, the more slower you are, the more steadier you are, the more you're putting your head on your shoulders, the more you know you're getting there. So it's all a combination of knowledge, attitude, coming together of that knowledge and attitude, and really, stepping back from any reaction mode. One of my mentors says, just yesterday he was saying to me, Priyanka, stop. Priyanka, now stop, notice. And give something up if there is something to give up on, wherever your attitude is concerned. So, stopping is just so rare. We don't stop. We don't notice. We just want to rush into stuff. So it's critical that we now stop. We notice. We look at what needs to happen. And every time an action doesn't need to be taken. Like you don't need to be in action all the time. You can just slow down and maybe not take any action at all. It depends on where you are, where your investment portfolio is. For me, most times there is really nothing to do. 17 years into investment journey, and for me I would say mostly there is nothing to do. Now I'm taking your attention on another article. So this was the cover story. Another article is on how to plan your retirement. A lot of us, we keep running after short-term goals. And we don't understand that if we tick the farthest goal first, we will be having more mind space and more peace, okay? I would say peace for making short-term goals happen. They become easier. Because if we only keep ticking short-term goals, the most critical goal is lost out. So how to plan your retirement is another thing, and I have been mentioning in the Money Gym program again and again that building your retirement fund is one of the important pillars of financial security. So here, this article is written by Uma Shashikant, who is chairperson of Center for Investment, Education and Learning. And she is defining different phases of our lives. She's saying there's a phase of 40 to 60, right? In which equity investing is key for appreciating your money, for your capital appreciation. So maximize your equity exposure, but maximize it only after learning about investments, only after learning about finances. Do not make the mistake of maximizing your investments and finances without understanding. Have SIPs, okay, in diversified mutual funds. Invest in stocks is what I would say. She's saying that an amount of 30 times your annual spend is a good thumb rule for retirement fund. So 30 times your annual spend is your retirement fund. Now, what are the different mistakes to avoid in this 40 to 60 year period? You investing in a big property, trying to put it on rent, trying to derive an income from that property. Don't make this mistake. First, go for equities. It's the best performing investment as yet. Second is investing in fixed income investments only, conservative investment options only. A lot of us, we keep investing in provident fund, post office investments, insurance cum investment policies and schemes, all these old traditional ways of investments, and we think that's enough. No, we ain't going to retire if we keep investing in these instruments because they don't beat inflation. The second phase is the 60 to 75-year-old phase, where you and I will be 60 to 75-year-olds. Now you may have assets of various kinds then. What will be critical in this period is you start consolidating. You start planning how to use these investments. What do you want to leave behind and what do you want to use? The post-retirement corpus must grow in value. So just because you are in the 60 to 75 year phase, do not stop investing in equity because a certain portion needs to continuously beat inflation. Otherwise, what happens after 75? And we women especially have longer life expectancies. So remember that. We need to be building more corpus, and that corpus needs to be growing, right? So invest in equity. You got to use the money, generate an income. Periodically you can also take out certain money. A certain portion of money has to be left untouched into equities for further growth of your money, which has to be used post 75. So let one portion appreciate and support you in fighting inflation. Investing 30% in equity at that point is a good thumb rule. Vijay Kedia, who is one of the mentors in the Women on Wealth community, is also the second biggest stock investor in our country. If you look at his portfolio is all over Google. If you look at his portfolio, 80% of his current investments are in stocks. Now, yes, there are thumb rules, but whatever be your age, the more you're into equities, but more understood equities, the more you increase your probability of creating wealth. The third phase is the 75-year plus phase, and here you need to simplify your life, is what Uma is saying. You don't have to manage too many assets, accounts, paperwork, so you need to consolidate your investments even further. Make it easy to manage. One bank account, one demat account, just a few mutual fund folios, and that's about it. So you know that, I recently got married. It's 2 months that I've gotten married, and And I took a printout of my consolidated account statement and I gave it to my husband so that he knows, where what is invested. In case something happens to me, he can take charge. And one copy my dad already has. So these are two people I completely trust, and I gave them, the entire list. And when I gave them the entire list and I was explaining, especially right now to my husband, where what was kept, I exactly noticed the same thing, that because I was financially educated, I had a financially decluttered life. Just one bank account, just one demat account, all the investments in that demat account, and those are also not cluttered. There are very few and smart investments, just a couple of mutual funds, just a couple of stocks, bonds, provident fund. That's about it. It's just so simple, one property. So, yeah, I think, it's not later in the years that you really simplify. I think if you're financially educated, you begin to simplify your life from the get-go. Because then it just becomes so much easier to manage. You know what you're doing. You understand your investments. It's like crystal clear for you. That's how I feel. Start typing, guys. What are you getting? What are you understanding? What are you learning today? Hi, Shruti, Diksha, Kaveri, Magi, Sonika, Pooja, Sima, Veena, Usha. Good morning. Good morning, my people. Kaveri saying this is a money gym first step recap. Planning and setting goals are so crucial. Equity only for goals that are at least 7 years away. And systematic withdrawal when the goal is less than 2 or 3 years away. Bingo. Kaveri saying the biggest eye-opener for me was that studying investments is a structured system. It is like learning chemistry formulas or maths equations. Learn the methods and systems and just apply them. It's so simple, right? Kaveri, it's just so simple. And we just keep complicating it. Magi is saying really sound advice. Pause and reflect. Absolutely. Usha is saying it is all about your risk appetite, and accordingly your percentage in equity varies. Yeah, and I would like to build on what you said, Usha. Not just your risk appetite, it's also how much you understand, how much you know, right? Because that's what builds the risk appetite. Today, when I know my companies, I know the certain mutual funds, then I can invest in them and be relaxed. And yeah, you can say my risk appetite is high, but if you look at from my perspective, it's not high. I know what I'm doing. It's as clear as that. Kaveri saying, I love the idea of simple, clean portfolio. Absolutely. That's my aim, Kaveri saying. Let's do that, Kaveri, then. Let's do that together. How many of you can share the video? I now invite you to share this video because I think it can contribute to a lot of women. A lot of women, men who are struggling with their finances, and this video can be their starting step into a good life, good financial life. Pooja is saying couldn't attend live for a long time due to some medical condition, but today I'm back and it feels so good. Pooja, good to have you back, and thank you so much for demonstrating that commitment. Right? You couldn't do it. Now that you're well, make sure nothing stops you. Just keep going. Seema is saying stop, notice, bring nothing to the conversation. Absolutely. Pooja has gotten some good insights. Got that. Veena has shared the video. Veena, what a privilege to have you guys be there at our back saying, we're with you in this mission. Thank you, Kaveri, for sharing the video. Love that. Usha is saying, yes, background study is always important. And that's how one builds the risk appetite. Absolutely. Thank you for sending in those lovely, lovely hearts. I love them. Thank you. Pooja, thank you for sharing the video. On this note, everybody, I'm closing the live. Thank you for participating. Keep coming back for financial growth. Loads of love. Diksha, thank you for sharing the video. Take charge, everybody. Bye-bye.